Hello and welcome to Yadnya Investment Academy. Today we will talk about a mutual fund category called equity savings fund. Equity saving funds are the latest type of asset allocation mutual funds introduced mostly in late 2014 when the government of India made the duration of debt mutual fund capital gains to be classified as long term from 1 year to 3 years. Think of equity savings fund as monthly income plans fund or debt oriented funds which are treated as equity funds from taxation point of view. Before going through this video, we would recommend you to watch our video on arbitrage funds to understand this topic better. Link is here. Equity savings funds aim is to generate returns from investments in equities, arbitrage trades, and fixed income securities. As we all know, fund is taxed as equity fund if it invests minimum 65% of overall portfolio in equity or equity related instruments. So to retain equity taxation, this fund category will restrict the fixed income or debt exposure to 35%. Besides, to reduce volatility and hedge the portfolio, these funds actively use derivative strategy by hedging their equity bets in future markets. Still, some amount of equity is unhedged, that is pure equity, to prop up the returns of the portfolio. The equity and derivative exposure is considered as equity allocation by SEBI regulation, and hence these categories of funds are treated as equity funds from taxation perspective. The hedged equity bets are almost risk-free and give returns equivalent to liquid funds. The unhedged equity exposure typically ranges from 15% to 40%, and the rest of the portfolio is hedged to gain from arbitrage opportunities. If you plot the fund categories on a risk-return axis, equity savings funds are positioned between MIP funds and balanced funds. They stand a notch higher than MIP or debt-oriented funds and one notch below balanced funds in their risk-return proposition owing to their pure equity allocation. Among these, balanced funds and equity saving funds are considered as equity funds from taxation perspective, and rest all three are debt. Here are the list of investment options you have in this category and their respective allocation in equity, equity derivatives, that is hedged equity, and debt instruments. So it clearly shows that this fund takes maximum risk in this category owing to higher pure equity allocation, and they take minimum, so choose wisely. Equity savings funds are suitable for those looking for some equity exposure but do not have very long-term time frame to invest. They suit those with limited risk appetite and looking for less uncertainty in returns. Many of these funds seek to provide regular dividend income, although they are not mandated to do so. We would suggest using them for intermediate term financial goals like 3 to 5 years, as well as conservative monthly income options. They still carry some amount of risk as they aim for capital appreciation from pure equity side. That is all we have on this topic. If you have any question, please do write in the comment section below, and do not forget to subscribe to our channel for more such options. Have a great time ahead. Jai Hind.